Thanks. If that's okay, I stand here in front. Let me just make my own introductions here. In the very back row is my family, my wife, her two sisters, my brother-in-law, and also a fraternity brother of mine, all of whom are University of Florida grads as well. So they're here to critique. I'm sure I'll hear about it all weekend. Tonight, or this afternoon, being a nice day, if you rely on my prepared remarks, you'll be out of here in about 10 minutes. So please, please interrupt. Please ask whatever questions that come to your mind. If I don't know the answer, I'll make one up. So what I thought I would do is give you a little bit of my history, my journey, and then I'm going to talk a little bit about common stocks with you guys, a little bit about Bahl and Gaynor, a little bit about how we pick stocks, how we invest, the history of our firm. I came to the University of Florida. Someone asked me at lunch, why did I pick, or after lunch, why did I pick the University of Florida? It's because I wanted to go to the University of Arizona. I applied there, was turned down because my brother and sister both went there, and they didn't want to have another one of my family there. That's the truth. But I wanted to go to someplace warm. I was scheduled to come here in the fall of 1969, and in May of 1969, my summer job fell through. And always being sort of in a hurry, I decided to start school in the June quarter, and I just kept on going. And I completed school here in 3 years, sort of by going through most of the sequential semesters. And I terminated I graduated from here in August of 1972, and I was scheduled to start at the University of Michigan in January of 1973. So I had 90 days and nothing to do. I actually got an employment by one of the professors in the business school to do some statistical work here. So I came down here for football season. It was great. Still being sort of in a hurry. The fine education I got here enabled me to pass out of accounting, economics, stats, and basic finance at Michigan. So I had a whole semester underneath my belt by the time I got there. So I was able to go through that program in pretty short order. I graduated from the University of Michigan in December 1973. I had 3 job offers. I had one at the Northern Trust Company for sort of an undefined role in their holding company. I had a job offer in the cash management department of Ford Motor Company. And I had a job offer at the Mellon Bank for their training program. I took the lowest paying job, which was the Mellon, because it really gave me a chance to do what I wanted to do, and that was manage money. Because the training program allowed you to go through the entire bank, whether it was the commercial lending department, cash management, the branches, or the trust department. So I arrived at the bank the day after the Miami Dolphins went for their entire undefeated season, before you guys were even born. That was January 1974. And there were 3 of us sitting in there. There were 2 Wharton guys and me. And they were pretty well heeled, and I'm just a guy from Cincinnati. And they said, we were just talking, and the guy who was in charge of the management development program says, where do you guys want to work? And I said, I wanted to work in the trust department. And these other 2 guys said they wanted to work in the trust department. He said, well, that's great. There's only 1 slot open. So you guys have to tell us who's going to get it. So there was a bit of a paper chase for a while, and that was fun. And I was able to get the job. And I started my security analysis career at the Mellon Bank right after my honeymoon in 1974. And my first job, my first area of coverage was the printing and photography and printing, photography, and reproduction business, which was essentially Eastman Kodak and Xerox. And my first recommendation for the pension funds that the Mellon was managing was Eastman Kodak. Now, if you've read the paper today, you sort of know where Eastman Kodak is. So anyway, it was actually a pretty successful recommendation because the stock continued to do very well, because at that time, the whole miniaturization of photography was coming into play. Digital wasn't even in their vocabulary yet. And they were making it easy by making really small cartridges for film and making flash cubes and flash bars. And the burn rate of film just skyrocketed. But I was fortunate after that, shortly after that, about a year afterwards, to be selected to go work in portfolio management. And I worked in an area, I really carried the bags for the guys who were working in the area, of managing the money for the Mellon family. So I was given a lot of responsibility very quickly. And I did that for 4 years, and had an opportunity to return to Cincinnati, where I grew up, and to work for a bank called the Fifth Third Bank in Cincinnati, which was a really small little bank there. But they had a really good trust department. And you know, through my whole career, I've been sort of at the right place at the right time. I've been really very, very lucky. The person who hired me was 62 years old, and he retired 3 years later. And I became the chief investment officer of the Fifth Third Bank in 1982. I was 31 years old. Sort of an awesome responsibility looking back upon it. Back then, I thought I was good enough for it, but looking back on it, I probably had no skills at all. So anyway, I did that for three years, and in 1985, you know, I had an opportunity to move to Chicago to work for the Northern Trust Company, to become their chief investment officer. And it was just a much bigger bank, much bigger operation. It was sort of the chief investment officer on steroids. Because not only did they have operations in Chicago, but they had operations throughout the state of Florida, state of Arizona, as well as Europe and Hong Kong. And I was supposed to be in charge of herding those cats. And that's what I did for 5 years. But as I found during my, my tenure at these bigger organizations, that my temperament was better suited to a smaller organization, one that was focused more on the client than focused on the organization that was perpetuating me. So I decided to, maybe 4 years into my job at the Northern, was to go back to Cincinnati and create an operation that was totally focused on the client, meeting their investment objectives and nothing else. And that's really what exists at Bahl & Gaynor today. We're now a $7.5 billion firm, and we manage money for about $4 billion of it is relationship business, and about $3.5 billion is what we call platform. But the relationship business is really our core business. It's a one-on-one relationship with the client, meeting their investment objectives, talking to them, trying to solve their investment problems. We have 500 clients and about 1,600 accounts in that business, and it's very sticky business. We have good results some years, and we have bad results some years. Over time, we've outperformed the market, but no investment philosophy or no investment strategy will outperform every year. Nobody's that good. The market is cyclical. So you have periods when you are underperforming, you have periods when you outperform. And the key is when you have those periods of underperforming is to have a really good relationship with your client, because it's just not the number. It's knowing what they're all about and having conversations. So you could put your performance statistics, whether they're risk statistics or the performance statistics, in context with the environment in which you're currently operating. So that's how we got started in Cincinnati with Bahl & Gaynor. And I'll tell you an anecdote that I told my father that I was going to give up this chief investment officer job at the Northern Trust. I had 4 children at the time, ages 1 to 11. And he said, "Bill, you're going to give up that job to do this with that guy?" It worked. Anyway, it was fun. So that's the sort of the genesis of Bahl & Gaynor. Let me turn to give you a little statistics on the firm. Maybe it's this way. Ah, it's the other way. Okay. Forward and back. All right. We created the firm in July of 1992. We started we weren't stupid about doing this, as I tried to convince my dad. We actually had a plan. And we had 3 families we talked to, and they had a combined assets of about $200 million at the time, who were willing then to leave the banks or the investment counseling firms that they were with and engage us at this fledgling firm with their assets. And they gave us $200 million to manage. We still have those clients. And we've had 22 years of good numbers and bad numbers, and we still got them. And that's really what we're all about. As I said, we have 500 clients, 1,600 individually managed accounts. And that, in some cases, we'll have one account per client. And I was saying at lunch today, we have one client where we just opened I think our 29th account. We manage money from the $10,000 or $12,000 gift to the brand new grandbaby, all the way up through great-grandma's generation skipping trust with $75 million in it. You don't turn down the $10,000 account when you got the $75,000 account. Just sort of important. We have $3 billion of high net worth money, $1 billion of institutional money, so that's the $4 billion of our relationship business, and then we have about $3.5 billion of what we call platform business. And that's where we have a relationship with the Northern Trust Company, Goldman Sachs, Merrill Lynch, UBS, US Trust, and 3 or 4 others. We just got hired by Morgan Stanley Smith Barney. And what we do there is we upload a spreadsheet of 2 investment strategies. One's called income growth, the other one's called quality growth. Those are model portfolios that we upload to those firms, and then their financial advisors decide whether or not to engage Bahl and Gaynor for, in our case, would be large cap domestic equities. And to the extent they use us, they then take that model and put it into their individual clients, into their individual clients' portfolios. And that business has grown from virtually nothing 3 years ago to $3.5 billion today. The problem with that business is the relationship. We have a relationship with a research analyst at Morgan Stanley and a team of research analysts at Goldman Sachs, and research people at UBS and Merrill Lynch. But we have virtually no relationship with the financial advisors who are employing our strategy. And that's tough, because then it's sort of the numbers that will dictate the growth or non-growth of that business. So we'll see. We're sort of new into this. It's grown very, very rapidly, but we've not gone out and put Picassos on our wall in order to share in the success of this business.
So, question, you were talking about some individuals or families that might have several accounts. So, I mean, do you have broad buckets that you tailor these accounts towards based on age, or do you have like a desire for growth, income, age kind of thing? I mean, you can't literally separately manage those many accounts, right?
Yeah, we do. Well, keep in mind we have 13 portfolio managers. I'll get into that a little bit. So 13 managers doing 500 relationships. The math becomes really very manageable. Okay. Because each person will handle a relationship. It could be 10 accounts in that relationship. It could be 1. Right. But you get to know the client pretty well in terms of what they need. 20 years ago, the asset allocation decision was much more complex than it is today. 20 years ago, money market funds were yielding 6 or 7%. Bonds were yielding 7, 8, or 9%, and stocks were yielding 2. So you actually had an opportunity to sort of moderate the risk with bonds and get income with bonds and then go for it in stocks. Today, money market funds yield 0, bonds yield very little, and stocks are yielding 3 or 3.5, depending on what strategy you want to use. So the asset allocation decision has gotten very simple. It's all equities, right? So we are an equity shop. Over 90% of what we manage is our common stocks. With all deference to Dr. Brown, the best thing that can happen to you in a bond is you get your money back and you get your interest paid on time. And it's a great way to lose capital purchasing power over time. A 10-year bond with a 2% inflation rate will buy less 10 years from now than it does today. Equities are really the only form of marketable securities that can provide you with a chance at growing purchasing power and in terms of income as well as in terms of the corpus of the investments you make. We have 15 portfolio managers, 12 of whom have MBAs, 9 have CFAs. Actually, we got about 9 2/3. We got one guy who's completed part 2. And we have 2 CFPs, chartered or certified financial planners. Extra credentialing after undergraduate school is essential. In our business, in the money management business, the CFA is the gold standard. It is the most rigorous self-study program we think you can embark upon, but it also gives us, as the employer, a sense of commitment to the industry, a sense of discipline, and a sense of real intellect, because it's a really hard test. I think the pass rate for the CFA is in the below 40%, and there are a lot of really smart people taking it. So maybe they're not all as committed as you might be, and maybe that's why the pass rate's down a little bit. My number 2 son just finished the CFA a year and a half ago, and I watched him go through the study process, and it was very difficult for him because he was pursuing a full-time job at the same time. I remember going through it myself and ruining 3 springs, but it is the gold standard. So anybody thinking about it, think again and take it, because it's worth the effort. You'll learn a lot. We have 1 IT manager. We have 1 full-time compliance person. When we started Bahl and Gaynor, I was telling the people at lunch, I did our form with the SEC on our kitchen table in about 15 minutes. It now requires hours and hours of lawyer time for us to update it every year. It's thousands and thousands of dollars just to keep current with our filing requirements with the Securities Exchange Commission. We have a full-time person who does nothing but compliance, testing, and making sure that personal trading policies are followed, and the testing and making sure that accounts are treated fairly, one account to another. Really boring job, but really important. We also have 4 interns that we have engaged. Really, we've done this for 6 or 7 years now. I bet you we've had over a dozen. We have hired, the University of Cincinnati has a co-op program where you work 1 semester, go to school 1 semester, and it makes the 4-year degree a 5-year degree. And it's called the Luminaire Honors Program. Carl Luminaire is a big benefactor of the University of Cincinnati, and he endowed this program, or they named the program after him, I guess. And it's been really successful for us. We have these really, really bright kids just like you. They look an awful lot like you, that have come through, and they've enriched our lives because they're, in many cases, smarter than we are. And it's helped us do things. They're just not faxing, and they're just not putting together books. They're actually doing the analytical work for us. They're putting together the performance statistics on our institutional products. All the things that we don't have time to do, they're doing. And it's been a real beneficial product. We hire people only with 10 years or more experience. You know, we want people to make mistakes, but we want to make them to make them somewhere else, at least the first ones you make. We continue to make mistakes. You know, 40 years into the business, we got guys 20 years into the business, they're still making mistakes, but you're not making the mistakes you make in the first 10 years. Make those somewhere else, then come to us. The last point here is we're 100% owned by us. You can only sell your firm 1 time. And it'd be real easy for us to sell it to a bank or to an insurance company or to a mutual fund company. But you know, the people that have come in to talk to us about selling to them, I ask them, I understand why this is good for me. I understand why it's good for my family. I understand why it's good for Gaynor. But tell me why it's good for my clients. Not one of them has been able to say, well, this is good for my clients because this, that, or the other. You know, I can't go to my client and say, guess what? Good news. I just sold out and I got lots of cash. You know, see my new Bentley Continental out there. You know, somehow they're not as thrilled for me as I am for me. Why is it good for them? So what we have done is we have really taken the tack to try to create a way where the younger members of our portfolio management staff become owners. So we've actually been very aggressive about trying to sell stock to them from us. We don't give it to them. We sell it to them at a really low price, and we actually lend them the money. We gave them a 10-year note, and they're paying us back over 10 years, really with our own money. But at the end of the day, they'll end up owning more of Bahl & Gaynor than we do. And that's the way you really want it to have happen, because 10 years from now, I'll be 71, Gaynor will be 75, and we're not going to want to work as hard as we are today. So when we're out on the beach, we shouldn't be getting all the rewards of their efforts. They should own the firm. It's sort of like a law firm. You want the people who own it to come in every day and work real hard. So that's sort of the primer on Bahl & Gaynor. Anybody have any questions about that? No? Okay, yes, sir.
You mentioned that in today's environment, it makes the most sense to have your clients' funds in equities.
Yeah.
Well, what happens in a time like now where it seems like equities may be reaching a plateau, yet bond yields are still very low, and obviously money market funds aren't yielding much either? Do you move the money into cash, or you just kind of bite the bullet in that instance?
Well, I can give you a flip answer, which I will, and then I'll give you the real answer. You know, Mark Twain said the most difficult time to invest was January, followed by February, March, April, May. You know, equities at a plateau. Yeah, they may be, but you're actually now 12 years into a secular bear market in stocks. I think you probably have one more dip to go. It's just a sort of a personal feeling. But it's really hard to be able to sell at the peak of the market and buy back in at the bottom of the market. Because I could tell you, in March of 2009, the market was 666, the S&P. Nobody was feeling like buying stocks, including me. So, you know, even though you might have picked 1525 on the S&P in October of 2007 as your peak, I can guarantee you wouldn't have bought anything in March of 2009. There are lots of people out there who pick tops of markets. There are lots of people out there who hit bottoms of markets. But no one I know can get them both together sequentially. And statistically, you have to be right 3 out of 4 times in order to beat the so-called buy and hold approach. So what we try to do is we try to buy companies that can endure a cyclical downturn and come out the other side as good as they went going in. So we sort of hang in there. But it's no fun when the market goes down, I could tell you that. Well, my number 2 son was interned at Merrill Lynch, and he came home, this was in 2000, the market was really, really falling down. It was the end of the internet boom and the stocks were cratering. He says, Dad, I know how to manage money. I said, really, Andrew? I said, yeah. He says, I've been listening to Mr. Annie, and he's on his phone with his clients, and he says, it's really easy. All you have to do is say, just hang in there. You know, so, okay. Anyway, you know, if you own good companies, you can just hang in there. Because you know those guys, the people that are running those companies are going to go to work every day. They're going to execute as hard, whether their stock price is 75 or 45. They're going to work just as hard. Because they're not dependent on the stock price. They're dependent on the number of units or whatever they're selling, or market penetration in the markets in which they operate. So if they work real hard, so what if the price goes down? As long as you don't need to sell, if you have an obligation, you know you have a big obligation coming up, whether it's an estate tax you have to pay, or kids' tuitions or things like that. Get that money and put that aside, and let the rest sort of ride. Because what you really want to do is capture the experience of owning the asset class. Sure. Okay. Forward. Our philosophy, you already said this before, but we believe in owning common stocks. We believe in owning common. Yes, sir.
You just said that you buy only good companies, and how you determine that a company is a good company?
Good company. There's all sorts of definitions, and there's no standard definition. But what we look for companies that have a product, mix that has a large moat around it, either protected by a large amount of R&D. Deep penetration into markets where they have established market positions. Strong balance sheets with little debt. High profitability, in other words, their products have big margins on them. Management team that is consistent, that's been there a while and not just dropped in from outside. Those are the sorts of things we're looking for. Does that help you? The rating agencies have ratings, but as you all know, if you've been reading the paper, the rating agencies don't always get it right. Okay. I've touched on a couple of these points before or earlier, but we own common stocks, which we believe over time will provide you with protection against inflation. They'll provide you with a growing stream of real income after you adjust for inflation. If you own the common stock of Exxon, for example, or Procter & Gamble, you get a dividend every year. And if that dividend grows at a rate faster than inflation, you actually have more dollars in your pocket in terms of purchasing power than you did before. You're participating in the growth of the economies. If those companies are growing, they're participating in the growth of the economy. And we talked about the higher quality situation. We just want to own, our approach is to own only companies that pay a dividend and grow their dividend. If they stop growing their dividend, that's a huge signal for us. Or if they stop growing their dividend at the same rate. If a company's been growing their dividend at 10% a year and they start growing at 2%, that's a huge signal for us. Merck, for example. Merck for years grew their dividend, it's a large pharmaceutical company, grew their dividend at 10 to 12%, and 1 year they grew it at 2%. And that was a huge signal for us. And why did they stop growing the dividend at the rate they were growing? Because dividends are cash. Cash that is leaving the company. Cash that they can't use to bonus out, they can't use for capital expenditures, they can't use to buy other companies. So if the cash is going out, and that is important, but if it stops growing as it's going out, that's also important to us. There are a large number of companies that pay a high dividend, but they don't grow. Your utility companies, for example. They might pay they'll pay a $2 dividend and grow, and the next year they'll pay $2.02. They grow the dividend, but that's not keeping up with inflation. We want a company that is paying a $2 dividend that next year is paying a $2.15 dividend. It doesn't need to go to $2.50. Then, of course, we could talk about Apple if you guys want to, a little later. And this is sort of what we talked about earlier. A company cannot pay a dividend if it's not earning money. A company that's continuing to pay a dividend and growing their dividend means that the earnings are growing. That means they're penetrating their markets, they're continuing to grow and make inroads. The quality of earnings is good. You all have taken enough finance classes and accounting classes, you know you can report any earnings you want. But it's cash that counts. If you're getting rid of cash, if you're actually letting cash leave the corporation, and you have all these funny earnings through accounting gimmickry, it's not going to last very long. Stability, of course. If you're actually departing with corporate cash, it does indicate usually the stability of the company, and financial strength, of course. The bottom 2 points here are really key and sort of new, really in the last 10 years. Through the entire history of the U.S. tax code, dividends were taxed at the same rate as ordinary income, at the marginal rate, the highest marginal rate of ordinary income. Up until 2003, it didn't make a bit of difference whether you had earned income, interest income, or dividend income. It was all taxed as if it was all taxed at the highest rates. Capital gains for many decades received preferential treatment. And so there was a disparity between the tax treatment on capital gains and the tax treatment on dividends. And it became extreme in the 1990s, particularly when the Clinton administration reduced the rate on capital gains from 28% to 20%. Because you had dividends taxed at 39.6% for the highest earners. You had capital gains then at 28 that became 20. That's a 50% of the tax rate on capital gains than you do on dividends. So when you have returns of dividends, income, and you have returns of appreciation. Where are people going to emphasize where they want their returns? They want to have the lowest returns on capital gains. And that contributed mightily to the internet boom that we had in the late 1990s. And we were told, there's a very good friend of the firm, stopped me on the street one day in 1999 or 2000. He says, "Bill, you got to drop this dividend stuff. You know, it's making you look really old." but you know, what happened then in 2003 is that the so-called Bush tax cuts came in and they lowered capital gains rates from 20 to 15 and the tax on dividends from 39.6 to 15. So now you have both sources of return, your income return and your appreciation, taxed equivalently. So you're indifferent as an investor as to whether you get it on the appreciation or you get it in the dividend, in the form of dividend. Actually, I would say you would prefer the dividend because it's cash in hand as opposed to cash on the come, right? So that stayed in place from 2003 until 2012. And the big, and I'm glad we didn't have this conversation 60 days ago because I didn't know. And I was very worried about what was going to be the impact of the fiscal cliff negotiations and the impact on the taxation of dividends. Because there was a school of thought out there that all rates were just going to go back to where they were. Capital gains were going to go from 15% to 20, and dividend rates would go from 15% to 39.6. Well, I have a lot of clients who are really dependent on income, and really dependent on dividend income. And they're going to have their tax rate go from 15% to almost 40% on their dividend income. It would have crushed them. But fortunately, what came out of whatever you want to call it at the end of the year was an equivalency codified in law permanently, as permanent as any tax rate can be, where dividends and capital gains are taxed equivalently. They're now taxed at 20%. Higher than they were, that's too bad, but they're equal. So you have, at least from a tax standpoint, no preference between your dividend income and your capital gains income. And that's, you know, and also, my second jab at fixed income of the day. Fixed income, interest income is taxed at 39.6 at the highest rate. And dividend income is now taxed at 20%. It looks like, it says 23.6, and that's, if they're in the very highest rates, there's a surcharge for the Affordable Care Act, depending on where your income is. And that's too complicated for me to understand.
Before you go on, let me just take a summary of this dividend idea. Tell me how wrong I am. So,
the best thing that can happen to you in a bond is you get your money back.
no. No, I'm not, so I understand that earnings are reliable of both quality. You can track, I think, or you can forecast or observe or monitor growing cash flow. And the idea of buying a dividend-paying company is that it speaks volumes to you about how sustainable the existing management team thinks that cash flow growth will be. So you're looking into the signal of the management. Is that a key part of it?
Yes.
But so that also layers into the fact that dividends, along with a seasoned and trusted management team together, would seem to.
That's exactly right. What we try to own are companies where the management team has a commitment to the dividend. I'm on the board of a couple of public companies, and one of which pays a dividend, the other one doesn't. And we were in meetings last week, and I bet you we spent an hour and a half talking about the dividend because of the commitment this company has to the dividend, paying the dividend, growing the dividend. And the shareholders have been with that company for a long time, many of whom care about the cash flow. Some of them are in retirement accounts and don't care. But there are lots of companies out there who have a stated dividend policy. We are going to pay out no more or no less than 35 to 40% of our earnings in dividends. And it's fairly forecastable.
Right.
But all of a sudden, if they go like Merck did, from a 10 to 11, 12% rate to a 2% rate, that's telling us something.
Right.
And coincidentally, and you guys probably are a little too young to remember this, but about 12 years ago, there was a product out there called Vioxx that was a pain reliever. And it turned out it caused, I think, strokes or heart attacks or something, and they had to be pulled from the market. And they did that right after the dividend rate was reduced. There were not a lot of rate reductions in dividends over history until the last 5 years, and particularly in the financial services sector. The banking institutions were sort of considered to be sacrosanct and well capitalized, and they paid their dividends and grew their dividends until they weren't capitalized well anymore by the toxic stuff they had. Yes, sir.
If you are interested in dividends and the reliability of the dividends, why don't you buy preferred shares instead of going to stocks? As long as the dividend yield is higher than inflation, I think you said, you'll be okay.
Well, preferred shares have a stated par value. Preferred shares are really no different than a bond. They have a stated par value and a stated dividend. And that dividend never grows unless it's an adjustable rate preferred. So it's equivalent of a long-term bond. Many of them are perpetual, and so it's a bond without a maturity with a stated rate. And the company really is in control because you don't have the ability to put that. You can sell it, but you can't put it back to the company. But the company generally has a right to call it from you. So many preferreds that were issued when rates were high have been called because it's advantageous to do so. The company says, I don't need to pay 8% on that money. So, but the preferred stock has preference in liquidation. So if something happens to the company, you get your secured bondholders first, then you get your subordinated bondholders, and then your preferred shareholders come in, and equity gets whatever's left. From our point of view, we don't ever want to be in a company that's in liquidation. So, by the preference or the enhanced position in the capital structure that preferred stocks have is of no advantage to us. And while you can get a higher rate dividend initially, you're not going to get the growth underneath it. Does that make sense? Yes, sir.
How does for your platform business, how does your compensation work? Is it like relative to the performance of the equities you provide, or is it more contractual, where you just are like it's an advisory service almost for them?
All of our fees are based on assets under management. So we actually, to the extent that Merrill Lynch uses our spread model in their accounts, we get a fee based on the amount in the various accounts that Merrill will have. It's an asset under management fee. We get no fixed fees. We have no per hour fees. It's just our fees are based on assets under management. So if the market goes up, our fees go higher. Market goes down, our fees go lower.
And you get that business through research, and then they supply it to their financial advisors?
Yeah. Merrill Lynch Research picks us. But what's happened in the last 15 years is banks and brokers. The traditional broker who would call up you or your parents and say, I think you ought to buy this and sell that, is gone, or largely gone. What Merrill Lynch wants their financial advisors to do, or UBS, the Northern Trust Company, Goldman, they want their financial advisors to pick managers. They want to get out of the stock picking business because there are lots of opportunities for lawsuits in picking stocks. So they do the research they used to do on Coca-Cola or IBM, they now do on money managers. So there's a list. Every broker has these lists of approved money managers, and we happen to be one of them for each of those firms. We happen to be, right now, sort of topical because dividends are very topical. and we have a higher yield, and the quest of yield, with money market funds not yielding much. And our performance has been pretty good. I worry when our performance isn't so hot, what's going to happen to that money?
So I'm having trouble understanding then why, like, maybe there's a technicality to it, why they wouldn't just invest in your fund?
We have a mutual fund, but it's not yet approved by Merrill, or it's not large enough yet. When it gets to be $10 million, it will be large enough, but it's not yet $10 million. So right now, they're uploading the spreadsheet and buying those stocks in their clients' accounts in the proportion that our spreadsheet dictates. And when we have a change, we upload that change, and it all sort of filters through like an Excel spreadsheet does.
Okay, so they're just all following the allocations that you guys...
Yes, sir. Yeah. Yeah. Okay, let's talk about dividends. This is really the power of why we like dividends. And I should have reversed, this is right. If you look at Disney, for example, in 1990, on a split adjusted basis, Disney paid 4.6 cents per share dividends per year. On a split adjusted basis, it was an $8 stock. So 4.6 cents on an $8 stock was a pretty low yield, like 1/2%, I think. Today, Disney stock, actually, when I did this, as of the end of the year, it was 49.79. It's now 55 bucks, but it was roughly $50 a share. The dividend is now 75 cents. So if you're Walt Disney, your dividend has gone from 4.6 cents a share to 75 cents a share. Underneath, I have the CPI. The CPI has gone up 78% in that 22 years. So in order for Mr. Disney to remain whole on his dividend would have to go from 4.6 cents to somewhere in the area of 8 or 9 cents. And he would have been even on inflation. But his dividend is 75 cents. His yield on original cost is 9%. So we bought a stock, Disney, in 1990 for our clients, that then yielded 1/2%. It now yields on its original cost basis 9%. That's the worst example here. Take Exxon, a company you all know. The highest yielding stock that we bought at the time with a 62-cent dividend on a $12.94 stock price, split adjusted, roughly a 5% yield. Today, the dividend is $2.18 on an $86 stock with a 16 or 17% yield on the original investment. That's just good stuff. And it goes, and so forth. Johnson & Johnson has a 27% return, dividend return on stock that was bought in 1990. And I can guarantee you, and you look at the stocks, J&J has gone from $9 to 70 bucks. Today it's 75. Illinois Tool Works. The dividend has gone from 8 cents to $1.50 with a yield of 24.5% on original investment. Coke at 18%, and McDonald's at 39%. McDonald's, when we were in business, McDonald's didn't have much of a commitment to the dividend. They paid a dividend reluctantly. It was then an annual dividend, and they hated it. But their shareholders, they wanted to become a shareholder-friendly company, and they have taken their dividend to become, it's now a central part of their capital allocation. And and the stock's been a rocket. It's gone from 30, from $7 to over 90 today. Yes, sir.
Do you place a preference on dividend growth or a higher dividend yield when you get into the...
We're really looking, well, you're managing the portfolio to a target yield. All right, so you could have some higher yielding stocks and some lower yielding stocks in it. So we're looking to dividend growth. If we're only looking to the higher dividend, we load our portfolios with utility companies. And I'd rather have Disney or J&J at J&J now at a 2% yield, Disney at about a 1.5% yield, than I would Southern Company with a 5% yield. Because 10 years from now, I'm going to really be glad I own J&J and Disney as opposed to Southern Company. Not that Southern Company would do poorly, but these guys will be much better for you. Yeah.
Sort of a follow-up to that. So, do you believe that the growth opportunities are going to outweigh such a gap, so if a company is yielding 5% now and another is at 1%, and if at 10 years they're both at 6%, I mean, the dividends that you would have been getting, I mean, not counting the growth of the company itself, would clearly be greater if you started at 5, right?
Right, yeah, but the lines cross. And in 20 years, you're way ahead. And you know, the problem that money managers like us have is how often do you have a 20-year run with a client? If they only got 3 years with you, it's a wasted period of time. You have to give these companies an opportunity to do their thing for you. Yes, sir.
In your presentation, you stated that in an inflationary environment, you prefer equities, but shouldn't rising interest rates prove a hindrance to earnings?
To earnings or to stock prices?
I would say both.
To earnings to the extent that they have leverage on their balance sheet that floats. There's an inverse relationship between rising interest rates and valuations. But it's going to be a while before that happens. If you look at the sensitivity of stock multiples, price earnings multiples to interest rates, strictly speaking, they should be the inverse. So if you have a 20 multiple is equivalent to a 5% interest rate. If interest rates go to 10, your multiple should go in half to 10. So what happens though is with interest rates where they are so low today, we think in sort of a perverse way, higher interest rates will be good for stocks up to a certain point. Maybe 3, 4, possibly 5%, but so let's just say 4. We have a long way to go with the 10-year at 2 to 4, because a higher interest rate would signify probably better economic growth. So, but once you get beyond 4 or 5% on the 10-year, you begin to degrade your multiple. It starts to go down. So we think we got some runway on interest rates before they become competition for us. But once you get back up to 6 or 7%, they become real competition for stocks. The problem is the bonds that you have in the portfolio that you bought at 2 and 3% in a 7% interest rate environment, the price is way down. You've lost a lot of capital unless you hold them to maturity. But then you've eroded a lot of your purchasing power because undoubtedly inflation's higher.
As a follow-up, do you think that, at what rate do you think that yields will have to go to start attracting attention from investors?
You know, there have been record money going into bond funds chasing yield for the last 10 years. So the lower rates have gone, it seems like the more money's gone into bond funds. It's been incredible. And those people, to the extent they stay in those funds, when interest rates rise, will be hurt badly, as their principal values of their funds will be slammed. So a rising interest rate environment is a real cancerous environment for fixed income securities. A rising interest rate for stocks, also, a rapidly rising and high interest rate for stocks, or interest rate environment, is also very bad for stocks. And you had that in the 1970s, where interest rates on the 30-year bond, I think, peaked at 14%, and on overnight paper, over 20%. That was a terrible time for both stock investors and bond investors. Nobody made money. Yeah. Yes?
What strategies do you employ when you determine whether or not you think a company is one that would be growing your dividend in the future? Is it more retrospective or prospective, some combination of those two things?
I was told earlier I was supposed to repeat the questions, and I apologize to whoever's filming this. I haven't done that. Your question was that retrospectively or prospectively, how does the dividend policy impact our decision making?
Not exactly. More of what sort of factors you look at to determine whether or not you think the company will be experiencing dividend growth over whatever time period.
Okay. What factors we look at to see what their capacity to pay the dividend is. Let's take Apple as a great example of that. Apple has $150 a share in round numbers of cash on their balance sheet. Steve Jobs was adamantly opposed to paying a dividend. Steve Jobs passes away. You now have new management in there. You got then, when Steve Jobs died, there might have been $90 or $100 million of cash on the balance sheet. So Tim Cook, the current CEO, is seeing this expanding cash on his balance sheet, yielding him how much? 0. So he has this enormous amount of cash on his balance sheet, this enormous asset on his balance sheet, earning him nothing. But he's held to certain return on asset standards, return on investment standards. So he has to do something with that cash. And if you read the Wall Street Journal today or you watched CNBC yesterday, you saw where an activist investor is trying to get him to figure out a way to get more cash to the shareholders. So what we're looking at are payout ratios of companies. Companies have been paying a dividend. One thing we have to be very careful about is a company that is growing slowly but growing their dividend rapidly. All of a sudden the payout ratio, the ratio of the dividends to the earnings, starts to expand. We look at that to see, are they getting over the tips of their skis on the dividend payout? And we saw that with many of the drug companies, Merck included, we just talked about. If the payout ratio starts to fall back because of maybe more rapid earnings expansion, might be a signal to us that the dividend is going to be increasing. We think that actually the codification of the preferential treatment of dividends, now permanently in the law as opposed to the Bush tax cuts, which were temporary, will allow managements to be more forthcoming with dividends. So there's a legal or regulatory tax environment for that. Is that helping you? Is that okay? Yes, ma'am.
Thank you. We're taking a long time on the slide, but to follow up on the conversation about growing the rate of the dividends, which should come from growing the earnings. So do you factor in the power to transfer price increases to the customer when you look at that aspect of the company when it comes to assessing whether they will grow or not the dividend itself?
We're looking at all factors. The question is, what are the other factors we're looking at to help the dividend policy in assessing whether or not the dividend is going to grow?
Yeah, so one of them is like the power to transfer price increases. Obviously, that as a function of business, how to do business, that it costs something and prices increase. So the company should have the power to increase it for their customers, and the customers should be able to absorb. That's what probably the growth can actually come, so you can grow the earnings and grow the dividend. So I was wondering how you look at it.
Companies have to pay dividends from somewhere. And the only way they can grow the dividends is if they continue to earn more. And whether all companies have rising cost pressures from wages or from raw materials or from regulatory environment. All those costs have to be factored in, and they have to pay, and then their ability to pass on costs to their customers. And we look at companies where they're getting squeezed at the bottom and the inability to push on costs. We talked at lunch about the banking industry and those who manage money market mutual funds. Money market mutual funds yield nothing, yet they have staff of people, smart people like you, making whatever salary they're making, and systems that are buying investments for those mutual funds, those money market mutual funds, and they can't take a fee on it because otherwise the money market fund would have a negative return because their fees overwhelm. That's not a good business. That's why we sold, Northern Trust in our case, which is a big money market fund manager for their global custody business. We said this is not a sustainable scenario for them, and it's not temporary. It was just a 1 or 2 year deal, but when the Fed says we're going to keep rates low through 2015, that isn't temporary. So we need to exit that business. So we're looking at we're looking at their pricing power, we're looking at their cost pressure, and their ability to navigate and go into new markets. It's all a factor. It's all factored in. Yes, sir.
Your strategy, the fact of growing dividend is clearly very important. So does it mean that you only invest in companies that are not yet mature? And if the company becomes a mature company, would you sell the stock?
If it becomes a what type of company?
Mature.
Major?
Yeah.
It becomes bigger.
Mature.
Mature, sorry. All of the companies here are mature. They were mature when we bought them. So the fact that a company matures doesn't necessarily make it a poor investment. It may, instead of growing at 12%, it may grow at 10 or 8. That's okay, because we also have moved into a much slower growth environment. So when we were investing, when it was a 12% grower in an environment where where overall growth was 4, we're okay investing if it's 8 in an environment of 1 or 2, because we have to sort of adapt to whatever's available. If I would have told my clients 10, 12, 15 years ago, 1998, that I'd be happy with an 8% return over time, they would have fired me. Because the environment prior to that, the 20 years prior to that, the 1980s and 1990s, you had an 18% compounded annual return on stocks. Not every year, but over that entire 20-year period, 18% per year. That's doubling every 4 years. So now we've gone 12 years, and stock prices are lower today than they were at their peak. Guess what? Everybody's happier with a lower return. So, you know, we take maturity into account, but so many of these companies still have, you know, greenfields in front of them. You know, Procter & Gamble, for example, or Coca-Cola, great mature company. If they can convince the Chinese and India to drink one more Coke a year, that adds points to their growth rate, because they have an opportunity in these countries where they don't yet have penetration. Saying that, I remember 15 years ago, my partner was a huge fan of Coke. He says, "Bill, all we need to do is get one more Coke in China," you know? And, you know, they've gotten one more Coke in China. Now we need 2. But we don't need 32 or 32 cases. We just need a little bit more. I mean, P&G bought Gillette 8 years ago. And you look at P&G's product profile, which is primarily products for women, and Gillette's products are primarily for men. And it was a great way to leverage the distribution system, so you could put both products through the same distribution channels. And then you looked at the geographic mix, and you looked where P&G was and where Gillette was, and Gillette was where P&G wasn't in terms of their geographic penetration, and P&G was where Gillette wasn't. And it was a home run for them. Now, they can't do that again, because P&G is so large that they have antitrust issues, which is to your point on maturity, is, you know, P&G now has to execute better. And that's their challenge right now. And causes us to scratch our head. I mean, living in Cincinnati, P&G is the big gorilla in the room, because they're local. We can't manage money for anybody in Cincinnati without encountering P&G.
So how do you decide when to exit an investment?
When the dividend growth stops or slows, you have a significant change in management. You have a significant change in regulation. I used the Northern Trust example a moment ago. You had the environment changed. It went from a very strong money management business in money market funds and in securities lending and foreign exchange. With the financial crisis, interest rates went to 0. That business went away, or became a negative, became a drag. So you have to look at these companies and make sure that they can sustain themselves. Pfizer, great pharmaceutical company, had a product called Lipitor. Lipitor is a cholesterol-reducing drug, and it was phenomenally successful, but it was 40% of their sales. And in 2011, it went generic. Now, we knew in 2008 it was going to happen. So, you know, we exited way ahead of the event. But, you know, we weren't the only smart people looking at it. There were a lot smarter people looked at it, too. So Pfizer was not a very good investment for a long time. But Pfizer has remade itself. It's a much different company today. We don't own it, but it's a much different company. So there are all sorts of things going on. So every single company we own in our portfolios, we got a high-quality portfolio. Every single company we own has given us heartburn. I had hair when we started this business. So, you know, every single company has caused us to seriously question whether or not we need to continue to own it. And a lot of them we exited, and many of them we got wrong, because they fixed it. Yes, sir.
I wanted to see how you felt about companies further leveraging themselves in the past fourth quarter and issuing large outside special dividends.
The question was the use of leverage and whether or not companies are, what the companies were about issuing special dividends. I'll take the easy one first. The special dividends was pretty easy. Dividend taxes were going to go up. We all didn't know how much. We knew that under the best case, they were going to go from 15 to 20. But under the worst case, they go 39.6. So you had a lot of companies, take Heinz, for example, who paid their dividend on, ordinarily pay their dividend on January 2nd. They paid it on December 27th, 5 days earlier. Whoever was a Heinz shareholder who was taxed got a bit of a bump on their after-tax income relative to had they held it. We're trying to figure out, actually quantify how much of the dividends in the fourth quarter were from, you know, that the S&P dividends were the result of special dividends. It turns out that the worst fears that many boards had about the taxation of dividends weren't realized. So those special dividends were one-time events. So Heinz this year, last year had 5 quarters of dividends payments. This year they'll have 3. So if you're a Heinz shareholder, your dividends this year are going to be less than they were last year. Over the 2 years, it's the same. The use of leverage. Lots of companies are borrowing money at very low rates. It's, you know, if you were a corporate treasurer, you should do so, because you can buy, if you're the corporate treasurer of Abbott Labs or P&G or Microsoft, you'll pay 3% for 30-year money. Can you employ your money at greater than a 3% return over time? Absolutely. The question is, how much leverage is good and how much leverage is too much? And we're not seeing that the corporations are being excessively, using excessive amount of leverage to take advantage of it. But on the margin, they're doing that. They're calling in debt. They're calling in debt they issued 5 years ago at 6%, refunding it with 3%. You know, just smart capital management. Okay. This is sort of the blind, you know, statement of the obvious. The stock prices follow earnings. Using the same prices, using the same chart on the left, there's the same numbers, same companies, and the same growth rates. Over time, earnings drive stock prices. If you have a company that is growing their earnings rapidly, the stock price will follow. Not every year, not every month, not every week, maybe not every 2 years, but over long periods of time, earnings drive stock prices. Earnings drive dividends. And that's really what we're all about. So we're looking at the earnings power of our companies first before we look at the dividends. We talked a lot about dividends, and I probably should have reversed it. But earnings really drive the stock price. It is no coincidence that the growth rates on the right-hand side are, they're not one for one, but they're fairly close to the growth rates in the middle of the chart. If you have 600, 700, 800% increases over a 20-year period in the earnings of the companies, you're also going to have very strong stock performance. That's what you need to learn in your MBA class. That's it. Equity lesson over with. So that's and now I have some pictures here I'll show you. Here's P&G. This goes back to 1973. This is when I got in the business, right here. The price line, and then the more smooth line is the earnings trend of that company. They are right on top of each other. No coincidence here. occasionally, stock prices get mispriced. If you look at the price of P&G in 1999, it was way ahead of its earnings. So that's a time when you might want to trim or sell. Also notice that P&G's earnings in the last 4 or 5 years have sort of rolled over. You know, the Gillette acquisition's been factored in, and they've had some trouble. They priced products inappropriately, in other words, too high. You had a recession where people traded down. They didn't use, instead of buying Tide, they bought Oxidol. Or instead of buying Cascade, they bought a store brand. There were a lot of trading down in consumer products over the last 5 years as people's wallets were impacted. So you saw the earnings roll over here. Guess what? The stock price rolled over. Exxon, probably the best company ever in terms of returns to shareholders over time. There are very few periods in my career where Exxon has not been a good investment. There are lots of 1-year periods and some 2-year periods, but there are very few 5-year periods or 10-year periods where Exxon hasn't been a superior investment. They've paid a dividend. You know, you can argue whether they're environmentally friendly, but they have really done the job for their shareholders. You'll notice this little blip here in 1990, where it sort of, this was the Valdez, when Exxon ran aground up there in Alaska. Cost them billions of dollars to remediate. Billions, tens of billions, much like what BP is now going through in the Gulf. But Exxon handled it well, BP did not. But you can see the very close alignment between Exxon's stock price and their earnings. When the earnings go down, the stock price goes down. It's just Target. Used to be called the Hudson Company. And you can see very close alignment between the stock price and the earnings. GE. Anybody read Jack Welch's book? Don't. Here's a company that's just really, really great company who got way ahead of itself in 2000. Jack Welch retired right there. He left that company with no gas in the gas tank. So the guy that came in, a guy named Jeff Immelt, came in. And then 9/11, 3 days later, 9/11 occurred. And Jeff Immelt said, a plane that I insure, powered by engines I built, went into a building that I insure. And that was the beginning of GE's decline. And then, of course, the financial crisis hit, and you saw what happened to the stock price in 2009. But GE is back on the mend. They've remediated their financial division, and I think GE actually is a pretty interesting company at these levels. And the stock price and the earnings line are on top of each other. It's usually a pretty good time to buy. Microsoft. This was sort of the mania we were talking about with capital gains earlier, capital gains and dividends. Microsoft didn't pay a dividend until 2003 or 2004. But here's a company, if you ever see this chart and you're investing money, there's a misalignment there between price and earnings in the late 1990s. Now, if you were Bill Bahl, you probably would have sold it in 1996. And you would have missed that whole upslope. But what you've seen in Microsoft in the last 10 years is the price has gone nowhere, and the earnings have continued to grow, and the multiple has gone from 70 or 80 times down to 10. It's actually a pretty interesting company. Next company is Cisco. Same story. Cisco Systems. There's nothing runs in this business without Cisco. In this building, I can assure you, if Cisco Systems blew up, this building would blow up. Very interesting company right now, selling at 11 or 12 times earnings. Stock price is aligned with the earnings. Intel, same thing. I guess I picked on too many technology companies, but those are the ones that are most interesting in terms of seeing the misalignment sometimes that stock prices get from their earnings. You get too much enthusiasm for what you're really getting in these companies. I told you I'd talk about Apple. Stock price never was overpriced, really. Here's a company that had real troubles in the 80s and early 90s until it really took off in the mid 2000s. But it was consistent with its earnings. It never got really overpriced relative to its earnings. Even at $700, it really wasn't overpriced relative to its earnings. So I think Apple's sort of interesting here. Risk. Gee, Bill, why do you own stocks? They're the most risky asset class. Fixed income is less risky, and I'll grant you that, because a big part of your return on fixed income is your cash, right? Because you're going to get your money back, so your return is all your cash. As interest rates have declined, the cash part of your return is of course less, and makes the asset more volatile in price. What we have here are the standard deviation of returns, which is the variability of returns around a trend line rate of return. And you can see over time, in the early period of owning a stock, in the first 5 years, stocks are clearly more volatile. But as the companies mature, or the investment matures, the volatility starts to decline. You can see that with bonds as well as stocks. But the standard deviation, this is a truncated chart here, it starts at 6. But you can see that the variability of stock returns versus a long duration asset such as a 30-year treasury isn't that much more. And then if you put on top of that, prospect for higher interest rates, we would posit that stocks are actually, on a risk-adjusted basis, pretty good. Okay, let's talk a little bit about our investment outlook here. We think that this will be no surprise to you, is we think the riskiest asset class right now is U.S. Treasury bonds. You've had a 30-year run in U.S. Treasuries. I'll advance to slide 1 because I think it's the next one. This is a 30-year history of bonds. It, in essence, takes the entire bull market in bonds on one chart. Interest rates peaked in 1981 and 1982, and they've had a continual decline till right now the long treasury is at 3.13. What you don't see on this chart is the mountain you climbed from about 1948 or 1955 or so. It's almost symmetrical in terms of how interest rates rose prior to 1982. And you've had a secular decline in interest rates. So over the last 30 years, bonds, long-term bonds, have outperformed stocks by a significant margin. So the next 30 years, our interest rate's going to go from 3 to -10? Probably unlikely. So we would say that right now, the Treasury bond is probably the most risky asset class. If you have any sort of lift in the economy, you're going to get some momentum on interest rates, which will degrade the price of stocks, or degrade the price of bonds. Sorry, Professor. Equities. I alluded to the fact I think that stocks probably have one more leg down, and it's not a real strong feeling, except that I'm not sure the economy is really that strong. Someone asked earlier, I think you asked earlier about the impact of special dividends. There was a statistic out that I saw today where the quarter-over-quarter growth rate in personal income, disposable personal income, was up 7 or 8% in the fourth quarter, largely impacted by advancing income into 2012, as well as special dividends because of better tax treatment. And there will be an 8% decline in disposable personal income quarter over quarter in the first quarter because of the absence of the dividends that were advanced in the fourth quarter, as well as the absence of the income that was advanced into the fourth quarter of last year. So there's going to, higher taxes have impacted everybody. While the tax impact for 99% of America was neutral, there was a 2% wage increase, a wage tax increase that impacted everybody. And that is money out of people's pockets, whether it's less money for gas, or less money for beer, less money for groceries, or less money for vacations. It's less money. So that will have an impact, and the market yet hasn't really, I'm sure it's figured it out, but it hasn't been really impacted there. Europe is a huge problem, and while it's off the front page now, it's going to come back, and that has an impact. China is slowing. That has an impact. So I think we have one more cyclical decline in stock prices. I don't know if that is 10%, 20%. I don't believe it's 50%. We had our big 50% decline in stock prices in 2007, 2008, much like we had the big decline in stock prices in the 70s, which was a 50% decline in 1973, 74. You sort of wash out people there, and then you rip their heart out the next 5 years after that until you're utterly demoralized, and that's when stock prices start to rise again. I am deregulation, also deleveraging. The consumer still has a lot of leverage on their balance sheet. The government, we talk about the deficit. There's no question that any sort of addressing the deficit is going to have an impact on it will be a de-stimulative effort. To the extent that consumers repair their own personal balance sheets, it means they spend less, save more, pay down debt, is all de-stimulative, and that still is sort of working through the system. So that's why I'm not particularly optimistic near term. But let me tell you why I'm really optimistic for the U.S. economy in particular for the next decade. We have a United States renaissance. We have energy and potential for energy independence. We have the best demographics out there, and we have a competitive currency. And the next slides will show this. We've talked about the bond. I'll come back to the S&P in a moment. Here's the U.S. dollar index. You can see the peak in the U.S. dollar index was in early 2000 at roughly 120. The U.S. dollar index is now at 80. So you've had a 30% decline in the value of the U.S. dollar over the last 10 years. You'll have taken enough courses knowing that when the dollar declines, U.S. goods become much more competitive, and that's having a real impact on U.S. manufacturing. And actually, the whole concept of outsourcing to Japan or to China or to Indonesia or Vietnam or India, many of those plants are coming back, or plants that were to go to less lower cost areas are not progressing as fast that way. Cash on the balance sheets. I think we touched on this a little earlier. The gold line there shows that this is a fairly short-term chart, but if you go back another 50 years, it's no different. You have a record amount of cash on corporate balance sheets today. The corporate sector is very healthy. The consumer sector is challenged. The governmental sector is very challenged. But the corporate sector is extraordinarily strong in terms of the quality of their balance sheets and cash. The challenge they have is a lot of that cash is offshore. And how do they bring it onshore in a tax-efficient fashion? And that's anybody's guess. And there's lots of conversation in Washington about how they're going to bring that back, and if they can bring it back at a rate that is taxed at a reasonable level. 15 years ago, or 20 years ago, in the early 90s, they had a tax holiday for foreign cash, and they taxed it, but they taxed it at a very low rate. The big companies that had the large amount of cash on their balance sheets at that time were the large pharmaceutical companies. Now it's the big tech companies. Apple has a lot of cash on its balance sheet, but a large part of it's offshore. But if they can bring it onshore, there's all sorts of opportunities to invest in the United States. The right-hand side is correlation this is actually correlation of stocks. We have a saying at our firm is when the market goes down, the only thing that goes up is correlation. And that means if the market really takes a header or takes a deep dive, it doesn't matter whether you own Exxon or P&G. It doesn't matter. They all go down. In 2008 and 2009, when the market was down, the stock market was down 35%, every single asset category, every single asset class, with the exception of U.S. Treasury bonds, went down, and down a lot. It didn't make a lot of difference whether you owned S&P 500 or emerging markets or high yield. You got hammered unless you owned U.S. Treasury bonds. So the only thing that goes up in a down market is correlation. And what we're seeing here is correlation is starting to come down. And if you go back and you look in the 1980s, you had low correlation. And if we get back in here, this is a true stock picker's market. This is where it makes a lot of difference whether you own P&G or Exxon, or McDonald's or Apple. But when correlation's up, it doesn't make a bit of difference. Okay. Demographics. The United States has probably the best demographics out there in the world. A lot of conversation about China. But if you look at this chart, this is a year old, but it came out of one of my favorite studies these guys did. And you look at sort of the trending of the population of China, and this has to do with the one-child policy. You can see it's rolling over, and in fact, the population in China begins to decline around the year 2030. And you look at working age Chinese, and the annual change there, it starts to drop off here imminently. So China, while a very strong market, is not going to be the engine of growth for the world economy going forward. It will be a powerful factor, but it will not be the driving force. I think we all know about Europe. This just sort of shows you, but the reason I put it here is it has the U.S. in blue. And you can see the continued rise, largely through immigration, of the United States population and the working age population vis-a-vis the Eurozone. You know, the Italian birth rate, I think, is 1.4. You know, it's in Germany, I think it's the same. It's very, very low. So, you know, Europe is sclerotic. It's in real decline. But the United States continues to be very viable. All right, we'll do a little economics for you guys. Before 1980, the biggest cost factor for American corporations was labor. And you'll see that from 1960 to 1980, the average annual rate of U.S. compensation, wage compensation was rising at 9% a year. It's huge. Productivity during that period of time was 2% a year. So your unit labor cost, which is your cost less your productivity, your unit labor cost was running at 6% a year. That was a huge headwind in owning any corporate asset. And they had to have pricing on the other side, and that's how you got the big inflation we had before you guys were born. But you had very high inflation, 7-8% inflation. That's what finally ultimately got you to 12-14% Treasury bonds and 21% prime rate. Then the 1980s occurred. What happened in the 1980s? Anybody guess?
Paul Volcker fixed the Fed.
Yeah, that caused a lot of things, but yeah, he broke the interest rate cycle. But what was the big fundamental change that happened in 1980? In the 1980s? Deregulation. You know, restructuring of the unions, and of course the technology boom. That's really the driver. The technology boom and deregulation are the major factors that caused productivity to go from a 2% annual rate to a 4% annual rate. Compensation grew at 4% because inflation was less. So you have now what in your unit labor costs? Flat, zero. No change in your unit labor costs. And what's happened over the last 20 years is corporate profitability has gone through the roof. As labor has become a lesser and lesser part of the cost as they've replaced people with machines and have added higher value added products. This is hugely positive for the United States. This is not the case anywhere else. This is not the case in Europe. It's not the case in China. China has double-digit wage increases. Very low base, but they're double-digit. This is a really cool slide. This looks at the capital expenditures in the United States 2.5 years into a recovery. The recovery in the United States began at the bottom of the recession was in the second quarter of 2009. And what this particular chart looks at is the 4 prior recoveries from the same point, looking at 2.5 years in the term of growth of capital expenditures, the growth of exports and imports from the base, from the bottom of the recovery, from the beginning of, actually the bottom of the recession, the beginning of the recovery. And the circled numbers there show you what's happened in terms of CapEx and exports since this recovery has started. A 12% increase in, average annual increase in capital expenditures was exceeded in 1982, but way above the average. Exports much higher than any of the other recoveries, and imports are on the low end of other recoveries. Going back to the dollar index, the export and import numbers are directly related to this phenomenon here. So this is good stuff. The last slide I have, and this is nothing new to you all, is the tremendous amount of change of what's happened in the U.S. industry, U.S. Energy industry. That we have gone from an import-dependent society well on our way to a self-sufficient society. Yes, sir.
What is the U.S. exporting? What's accounting for the 9% growth?
The natural gas. The price of natural gas in the United States is $3. The price of natural gas in Europe is 12. The price in Japan, I think, is 14.
But is it solely energy?
Oh, on the prior chart?
Yes.
Oh, I'm sorry. It's energy. It's technology. It's capital goods. It's widespread. It's not a singular. It's not monolithic. It is widespread. I thought you were talking about energy. I'm sorry. But the fracking and the extraction of tight oil and tight gas and the Bakken fields, the Marcellus trends, while environmentally sensitive, is a huge game changer for the United States in terms of energy independence, our imports, and our ability to sort of determine our own destiny. And you can't explain, or you can't have a bullish point of view on the United States without this being the case. So as a result, I'm very, very positive on the U.S. economy. I'm positive about the companies that are vested in the U.S. economy, and I think it's actually going to be an exciting period. I told you I was going to go back to the S&P 500 chart. Now, unfortunately, this chart begins in 1969. I really wish it began in 1965, because what you had in 1965 was the peak of the prior bull market that began in 1948, somewhere down here. And it had the same trajectory as this bull market did from 1982 to the year 2000. It was about an 18-year bull market where stock prices went up about tenfold. And then you had a period from 1965 to 1982 where stock prices basically trundled back and forth between 500 on the Dow Jones. I'm mixing my metaphors here, but 500 on the Dow Jones to 1,000 on the Dow Jones, and it went back and forth for about 16 or 17 years. And that period, 500 to 1,000 doesn't sound like much, but it was traumatic at that time. In 1973, this whole point right here is the day before Richard Nixon was inaugurated for his second term in office. The Dow peaked at 1,053, and 9 months later, it troughed at 575. Well, I'm sorry, 21 months later, it troughed at 575. About a 45% decline in stock prices. This point right there was around $15,000 on the Dow, I think. And this point right here was about 6,600 on the Dow, a 56% decline in stock prices. Very traumatic. The point is that this period of time here was a period of high inflation and higher unit labor costs and rising bond rates and falling stock multiples. Stock multiple in 1965 was 20 times earnings. When it emerged, it was 9 times earnings. Went from 9 times earnings to 22 times earnings. Today, it's 13 times earnings. So you get one more cyclical washout and they take 20% off stock prices. The multiple goes from 13 to 10 or 11. And that's probably the emergence of the next big secular bull market that we think will be led by the industrial, the industrial renaissance that we're talking about, the self-sufficiency of energy in particular. And that makes us really, really excited about maybe all of the next 10 years, but maybe the first 2 might be a little dicey. Yes, sir.
So you have the secular bull market running from 82 to, say, the tech bubble in 2001, largely driven by technology changes. Do you think that the change in technology and what it did for the U.S. economy, do you think that'll be analogous to what shale gas is doing right now for the economy?
I'll tell you in 20 years. But it could be. Shale gas could be the game changer that causes the trajectory of the next secular bull market, where multiples will go from low double digits to maybe mid to high teen multiples. The stock market is cyclical, but it has very predictable long patterns. And this was a long pattern here. This was a long pattern here. And we're right towards the end, I hope, of a long pattern of consolidation. You don't have, no asset class goes up forever. So when you have 2 decades of stock prices going up 18% per year, it can't go on forever. So you've now had 2 decades, you have a decade and a half, of stock prices going nowhere. So now you put all 4 of those decades together and you get something around 9. It's going to be different then, but just sort of putting the numbers together, it's something around 9. And that's where I said I'd be happy at 8. You guys have a great advantage ahead of you. You're in your 20s. You got 6 decades where you can invest and save. If stock prices rise at a 7% rate, which is sort of where they have in the past, you have 6 doubles ahead of you. So, just double whatever you want to double, whether it's $1 or $100,000, double it 6 times, you get a really big number. And I say to my children, I say, the money you save now and you put away and you invest is truly high-powered money. So you got 6 doubles ahead of you. Just think about that as you go through your investing careers and your lives. It's really high-powered money available to you, and that would be my parting shot. I did know that one of your speakers gave out some names of books that they thought were good, and I have my list, if that's okay. The financial crisis was a game changer for the entire world. And there are 3 books in there. You really only need to read one of them, pick one. I think the best is called On the Brink. It was written by Henry Paulson, who was the then Treasury Secretary. Has anybody read it? The other one that's analogous to it is called Too Big to Fail, and that was written by Andrew Ross Sorkin. Same book, same story, bad novel with a bad ending. But it's extremely instructive of what was going on in 2005 through 2008 and how they went about trying to address the financial crisis, what caused the financial crisis, and how they fixed it. And it was truly scary that none of them in powers, whether it was Tim Geithner running the New York Fed or Henry Paulson running the Treasury, none of them had an idea or a clue how to fix it. And they happened on this thing called TARP that really was, in my opinion, a stroke of genius, although it morphed into something very different than what it was intended. If you're really interested in this stuff, the first book you ought to read on that is called House of Cards, which is about the demise of Bear Stearns, which sort of started the whole thing falling down. The other book you ought to read is Steve Jobs' book, Walter Isaacson. It's a fabulous read about a really strange guy. But it gives you a sense of really a genius at work and how he built that company from nothing, took it down to nothing, and then built it to what it is today. It's a fabulous book. And then a number of you, I think, are going into investment banking. Who's going, anybody got jobs going into investment banking? You need to read Dethroning the King. It's about the takeover of Anheuser-Busch and how a corporate iconic brand and company was so mismanaged, and then the process of how the investment banking iterations between them and InBev worked. It's really, for those who are going into investment banking, I think it's a great read. It's really easy. You know the product, I think, so you can appreciate it. But but you know, also just from an overall business standpoint of how a great brand and a great company, you know, really was led down the path to mediocrity, and how they really were forced to merge. It wasn't their choice. They were forced to merge. And it's a good read, too. That's what I had. Yes?
Go ahead. Since you mentioned these books, I just wanted to see what you have in mind for equity research or some interesting books that you...
Equity research books? You got to start off with Graham and Dodd. Okay. It's been a while. Let me think about that. I'll come back to you on that. Equity research. I'll have to think about that one for a while. Go to the CFA curriculum. The CFA curriculum's got it all there.
So I've got a question for you. So at the beginning you mentioned you have sticky money, your customers.
Yeah.
I bet I could guess that on a lot of them, you talk about being close to the clients, that kind of thing. But it would also occur to me that your the vernacular style conviction is high. So, I mean, the investors, when they get their statements from you, they're not surprised. They may be disappointed by the performance, but they can read the Wall Street. They know where you're at, right? They know what you own, and you own these things in this business. So do you think that's very important for retaining clients? Is that you never worry about what you're doing?
Yeah, you have to, no surprises. Your comment is something we talk about a lot. We do not want to have any of our clients be surprised about what they own. We don't want you've seen the ads for, I forget who is a TD Ameritrade or somebody about afraid to open their statements. You know, I don't want to open mine, do you want to open yours? While the news may not be great in terms of asset values, what they own, they understand why they own it.
Right.
And in almost every case, their income is higher this year than it was last year. Right. We do seminars for kids, for high school kids of our clients. And we give them a glass, and one glass says Bahl and Gaynor. On one side it says Bahl and Gaynor. On the other side it says, thou shalt not spend principal.
Right.
And you know, that's sort of the 11th commandment, is if you discipline yourself only to live on the income, right, it doesn't matter whether your value of your portfolio is $1.1 million or 900,000. But chances are your income is higher than it was last year, because IBM has increased their dividend, and Coke has, and GE has, and Exxon has. So your dividend's higher, and you're spending more money. You may now be taxed a little bit more because of the change in the tax law, but you still should be ahead of the game. So we've preserved your income, and if you've been with us long enough, you know it comes back. Our biggest problem is getting hired at the peak of a market And their $1 million portfolio is 800,000 in 9 months because the market's down 25%, and we're down 20, and we feel great. But they don't feel so hot about it.
Anybody else? Thank you very much.
Thank you.